At the end of every month, from now on, any money you haven't spent disappears. Not devalued, not taxed, gone. The cash in your wallet, the number in your banking app, the balance sitting in a business account or a government treasury, whatever hasn't changed hands by midnight. On the last day of the month, resets to zero. Prices don't change, wages don't change. Interest rates, contracts, laws, all still exist. The rule touches exactly one thing: money's ability to survive past the calendar page turning. The first response is the one you probably already thought of. People spend everything before the deadline. And for the first few months, that's mostly true. The last week of the month starts to look like Black Friday, except it happens 12 times a year, and nobody's excited about it. Stores get slammed on the 28th, 29th, 30th. Restaurants that are dead on a Tuesday afternoon are suddenly full on the last Tuesday of the month, even at 2 p.m., because someone would rather eat an overpriced lunch than let $40 vanish for nothing. Malls start scheduling extra staff for month end, the way they currently do for holiday weekends. But burning cash on lunch you didn't need is a crude solution, and people figure out fast that spending and losing value aren't the same thing. If you take your leftover balance and buy something that still has value tomorrow, a phone, a bag of rice, a gift card, you haven't lost anything. You've just moved your money into a form the expiration rule can't reach. The currency disappears. The stuff you bought with it doesn't. That distinction is where the real behavior starts. Gift cards become a genuine financial instrument almost overnight, because a gift card balance isn't money under the new rule. It's a claim on a business, and that business's own promise doesn't expire on the 31st. People start buying large denomination gift cards from grocery chains, gas stations, anywhere they know they'll eventually shop, purely to store value that would otherwise be wiped out. Retailers notice the surge and start advertising it directly. Buy a $500 card this week, and technically you've beaten the clock. A few, half joking, start calling it the only bank that's still open on the 31st. Foreign currency, and anything crypto-denominated, becomes the more obvious workaround for people with a bit more financial literacy. If the rule only applies to the domestic currency, converting to something else at 11 p.m. on the last day of the month, and converting back on the 1st is a completely rational move, and apps built specifically for that 30-minute window appear within the first year. It's not really investing. It's laundering time, not money. The most interesting version of this workaround, though, isn't buying things or converting currency. It's paying people in advance. If you owe rent, insurance, a gym membership, a phone bill, anything with a recurring cost, the smart move is to pay as far ahead as the other party will let you. A tenant who has $2,000 sitting in an account on the 29th doesn't want to waste it on frozen pizza. They want to hand it to their landlord as 4 months of rent, because rent paid is rent no longer sitting in an account waiting to be erased. Landlords, insurers, and utility companies quickly become something they were never quite designed to be. Places where people go to store value they can't keep any other way. This is where businesses realize they're suddenly in a strange position. A landlord holding 6 months of prepaid rent is holding an amount of money that, at the end of this month, is subject to exactly the same expiration everyone else is running from. The business hasn't escaped the problem, it's just inherited it one step removed, along with the responsibility of not losing a tenant's stored value, along with its own. Naturally, some businesses lean into this. A gym starts advertising 3-year memberships at a discount, explicitly framed as a place to park your money. A mattress company offers store credit that never expires as a purchase incentive, positioning itself, without irony, as safer than a bank, and some people get burned. A business collects a year of prepayments and then closes, and everyone who trusted it as a vault loses whatever they'd stored there. It's the oldest lesson in finance arriving through a completely new door. Whoever holds your stored value can fail. And when they do, so does what you thought you'd saved. Businesses themselves have the harder version of this problem because it isn't optional. A company's cash reserves, the buffer that gets it through a slow month, an emergency repair, a bad quarter, used to just sit in an account. Now that account resets to zero on schedule. So any business that doesn't spend, invest, or distribute its cash by month's end simply loses it. Retained earnings, in the old sense, stop existing. Every company is forced into constant reinvestment. New equipment, new hires, new inventory, expanded space. Not necessarily because it's a good time to grow, but because holding still means losing the money outright. Growth becomes the default, not a choice, and the businesses that struggle most are the ones that used to survive on a healthy cash cushion during a rough stretch. That cushion no longer exists for anyone. The most consequential adaptation, though, comes from a slightly different insight than, quote, cash into stuff. It's the realization that lending your money to someone else also escapes the expiration, because once you hand cash to another person as a loan, what you're left holding isn't currency anymore. It's a promise, a claim that they'll pay you back next month. And a promise on paper doesn't reset to zero at midnight, because it was never currency in the first place. This turns lending from a specialized activity into something close to a monthly reflex. Instead of watching $600 evaporate on the 30th, you lend it to a coworker, a cousin, a neighbor, on the informal understanding that they'll return it, plus a little extra. Because why wouldn't you charge interest on the only thing keeping your money alive? Small, informal IOU networks spring up inside friend groups and apartment buildings almost immediately. Not because anyone planned it, but because it's the most obvious way to convert a number that's about to vanish into a number that survives, attached to someone you trust. Formal lenders, banks, credit unions, whoever's still standing in whatever form banking takes under this rule, end up busier than ever for the same reason. A bank that lends money out is, structurally, doing the same thing as your cousin, converting expiring cash into a non-expiring claim. Loan demand and loan supply both spike, because everybody with a surplus wants to lend it, and everybody without one is happy to borrow at rates that are suddenly more favorable, since lenders need to place their money somewhere before the deadline, just as badly as borrowers need to receive it. What used to be saving quietly turns into lending. You don't build a balance anymore. You build a list of people who owe you. And that shift changes what actually matters in this economy. Trust becomes the scarce resource that money used to be. $1 in your account was reliable because a bank, a legal system, and decades of institutional habit backed it. A promise from your neighbor is only as good as your neighbor. People start keeping informal records. Who paid back last month? Who didn't? Who's good for it? Reputations start functioning the way credit scores used to, except they're built out of lived experience with specific people, instead of a number from an agency. Defaulting on a small loan stops being a minor annoyance and starts being genuinely costly, because the next time your cash is about to expire, nobody wants to be the vault that takes your currency and gets nothing back. Governments run into their own version of the same wall, quietly, in the background. Tax revenue collected in an account is just as exposed as anyone else's. So treasuries that used to hold reserves for emergencies, a bad harvest, a natural disaster, a recession, can't anymore unless the rule is written to exempt them, which becomes one of the first and most contested carve-outs anyone proposes. A government that can't hold a rainy day fund has to either spend everything immediately, on schedule, whether or not the timing is good policy, or ask for the kind of exception ordinary people don't get. Either answer tells you something uncomfortable about who gets to opt out of a rule everyone else has to live inside. None of this collapses the economy. If anything, money moves faster and more visibly than it ever did before. Every dollar earned this month is either spent, converted, prepaid, or lent out again within weeks, with almost nothing sitting idle anywhere in the system. That's the entire outcome that a rule like this was designed to force. And in a narrow sense, it works exactly as intended. What it quietly ends is the idea that a number in an account is the same thing as wealth. Wealth stops being what your balance says, and starts being what you actually own outright, or what other people owe you and are good for. The dollar becomes something closer to what it originally was supposed to be, a token you hand off to make a trade happen, and stops being something you can hold on to and call a nest egg. A currency that can't survive the month stops being a warehouse. It becomes a relay baton, and the only real question left is who you trust enough to hand it to before the clock runs out.